Imagine, imagine your client passes away on June 15th.
Okay, tragic, but it happens.
Right. And they ran this wildly successful, strictly cash basis business their entire life, which means, they only ever reported income to the Bureau of Internal Revenue when the physical cash actually hit their hands.
Which is pretty standard for a cash basis setup.
Exactly. But on the day they die, they have like millions of pesos in uncollected receivables just sitting out there. So the question is, does the BIR just wipe the slate clean because the taxpayer ceases to exist?
Oh, absolutely not. I mean, not even close.
Right, because when the unstoppable force of Philippine tax law meets the immovable object of human mortality, things get incredibly complex.
Yeah, the rules completely shift to make sure that uncollected cash doesn't just, vanish into the ether totally untaxed.
And that right there is exactly why you are here with us today. Welcome to another session of ICPA Review Radio.
Glad to be here, diving into the messy stuff.
Yeah, if you're listening to this deep dive right now, you are gearing up for the CPA board exam, and today we are giving you a massive edge in taxation.
A huge edge, because we are breaking down tax accounting periods and methods. Specifically, we're looking at sections 43 through 49 of the tax code.
And we chose this specific topic because, honestly, it is an absolute gold mine for examiners. It's one of those highly testable areas where standard accounting principles like your PFRS collide head-on with very, very rigid tax rules.
Yeah, examiners love this space because if you just apply normal accounting logic to a multiple choice question here, you will almost certainly get it completely wrong.
Yeah, they set traps.
Oh, totally. PFRS is all about matching and economic reality, right? But the tax code, it's often about administration. It's about control and making sure the government gets its share on time,
Makes sense. So today we're going to explore the mechanics behind these rules. So you don't just memorize them, you actually understand the underlying logic.
which makes recalling them on exam day so much easier.
Exactly. So let's start with the fundamental concept of time. Um, to understand tax periods, I always like to think of a business as a continuous 24/7 video feed.
Okay, I like that analogy. The business never really stops operating.
Right, it doesn't stop. But the BIR, they can't tax a continuous video feed. They need you to, chop that video up and hand them a series of 12-month photographs.
Yeah, discrete periods. And Section 43 dictates that your taxable income must be computed based on that 12-month photograph.
Which is your annual accounting period.
Exactly. Whether that is a calendar year ending December 31st or a fiscal year ending on the last day of, well, literally any other month. And it generally should follow the regular accounting method you use to keep your books.
Which sounds perfectly reasonable, right? Like if your business naturally operates on a fiscal year, say July to June, you just file your taxes that way.
You'd think so,
Hmm.
but the law places severe restrictions on who actually gets to make that choice.
Oh, right. Because they don't just let anyone use the fiscal year.
No, not at all. The tax code explicitly states that your taxable income must be computed strictly on a calendar year basis under four very specific conditions.
Okay, lay them out for us.
First, if your annual accounting period is not a fiscal year. Second, if you don't have an annual accounting period at all. Third, if you don't keep books.
Makes sense. If you don't have a system, you default to the calendar. And the fourth.
Or fourth, if the taxpayer is an individual.
Wait, hold on. I really want to test that fourth condition because this is exactly where candidates get tripped up on the boards. Let's look at a hypothetical.
Sure, let's do it.
Let's say our taxpayer is Juan de la Cruz. And Juan is an individual running a very lucrative sole proprietorship, like maybe a seasonal beach resort.
Okay, it's a seasonal business.
Yeah, and his absolute busiest time of the year wraps up in October. So from a pure business and accounting perspective, it makes total sense for Juan to close his books and end his tax year on October 31st.
It makes perfect economic sense, yes.
So are you telling me the BIR won't let him do that just because he's an individual?
They absolutely will not let him do that.
Wait, really? Not even with a perfectly good business reason?
Nope. And on the board exam, they will give you this beautifully written, highly compelling word problem explaining exactly why one should be using a fiscal year.
Just to bait you into choosing it.
Exactly. They want to tempt you into saying yes. But the rule is incredibly rigid. Individuals are strictly bound to the calendar year.
But why, though? Why does the BIR actually care if Juan's business cycle ends in October?
It really just comes down to administrative chaos.
How so?
Well, think about the sheer volume of individual taxpayers in the Philippines compared to, say, corporations. if the BIR allowed millions of individuals to arbitrarily pick their own fiscal years.
Oh, right.
Yeah, tracking compliance, matching withholding taxes, and conducting audits would become an absolute logistical nightmare.
I didn't even think about withholding taxes. That would be a mess.
It's total mess. Plus, it would open up these massive loopholes for tax evasion through calendar shifting.
Yeah.
So standardizing all individuals to a single December 31st cutoff, it just keeps the system manageable.
Got it. So only non-individuals, like corporations or partnerships, have the privilege of using a fiscal year.
Precisely.
Okay, that makes a lot of sense. The sheer volume dictates the rule. So for everyone taking notes out there, here is your quick recall aid. Just write down IC.
I see. I like that.
Yeah. I for individuals, C for calendar. If you see an individual taxpayer in a word problem trying to use a fiscal year, you just use the IC rule. Individuals equal calendar. Spot the error immediately and move on.
It's a great mnemonic. It'll save you a lot of time. And going back to Section 43 for a second, there's an override rule you must keep in mind.
Okay, what kind of override?
Well, we said earlier that you follow your regular accounting method, but what if your books are just a total mess? What if that 12-month photograph you hand the BIR is blurry?
Oh, I see where this is going.
Right. If a taxpayer has no regular method of accounting, or if the method they use does not clearly reflect their income, the commissioner has the ultimate authority.
They can just step in.
Exactly. The computation will be made using a method that, in the opinion of the commissioner, does clearly reflect the income.
Wow. So the BIR can literally just look at your return and say, we don't like how you calculated this. Do it our way.
Yes, they have a ton of discretionary power there.
That is huge. So, all right, we've established the 12-month boundaries. We know what year we are in. Now we need to look at when exactly to report the money flowing in and out within that year.
Right, which brings us to the timing rules governed by Sections 44 and 45.
Let's break those down.
Sure. So Section 44 covers gross income, and it says items of gross income are included in the taxable year they're received, unless, of course, your permitted accounting method, like the accrual method, dictates otherwise.
Right. And Section 45?
Section 45 handles the other side of the equation. Deductions are taken in the taxable year they are paid, accrued, or incurred, depending on your method.
Okay, which brings us right back to that dramatic scenario we opened the show with.
The client dying halfway through the year.
Exactly. The cutoff caused by the death of a taxpayer. Because this is a scenario examiners absolutely love.
Oh, they love it.
Yeah.
Because it forces a sudden, involuntary change in the accounting timeline.
So let's logic through this together for the listeners. Our taxpayer passes away on June 15th. For decades, they have been strictly cash basis.
Okay, cash basis.
Yeah. They have millions in uncollected receivables out there, and maybe millions in unpaid business expenses, too.
A very realistic scenario for a successful business owner.
Since they died halfway through the year, how does the final computation actually work? Do we just file a return for the cash they physically touched between January 1 and June 15?
Not at all. Both Section 44 and Section 45 have very specific clauses just for the death of a taxpayer.
What do they say?
For that final taxable period, you must include all amounts accrued up to the exact date of death. And here is the really crucial part that candidates miss. You include those accrued amounts even if they wouldn't normally be included under the taxpayer's usual cash basis method.
Wait, hold on. Are you saying the BIR forcefully converts a cash basis taxpayer into an accrual basis taxpayer on the exact day they die?
Precisely. It is a forced accrual.
Why do they do that? I mean, that seems incredibly harsh to suddenly change the rules on someone's final, deathbed return.
It seems harsh, but it's really about protecting the tax base.
How so?
Well, think about it. If a cash basis individual dies, they cease to exist as a taxable entity, right?
Right.
If the law didn't force an accrual, those millions of pesos in uncollected receivables would eventually be paid to the estate or the heirs.
Okay.
But they might never actually be taxed as the decedent's income because the decedent wasn't alive to physically receive the cash.
Oh, they'd just slip through the cracks.
Exactly. So the BIR prevents this income from escaping by essentially saying, death stops the clock.
Oh.
Everything you earned up to June 15th, whether you actually collected the cash or not, gets accrued into your final tax return.
That's fascinating. And does it apply to deductions, too?
It does, to be fair. Any expenses you incurred up to June 15th but haven't paid yet are also accrued and allowed as deductions against that income.
Okay, that is a brilliant mechanic to understand for the exam. Death forces an accrual up to the exact date of death, regardless of whatever prior method they were used.
Exactly. Just remember,
Gotcha.
forced accrual upon death.
So that's an involuntary cutoff. But what if a living, breathing corporation voluntarily wants to cut its year short? Say they want to change their accounting period entirely.
That is allowed under Section 46, but you can't just do it on your own. It requires the prior approval of the commissioner.
You can't just change your calendar on a whim.
No, definitely not. But mathematically, if you do get approval to change periods, it creates a broken year,
A gap.
right? A fractional year of less than 12 months, which is then governed by Section 47.
Let's map this out so the listener can really visualize the timeline. Let's say a corporation has been operating on a standard calendar year ending December 31st.
Okay.
They request and receive the commissioner's approval to switch to a fiscal year ending June 30. So they just celebrated New Year's Eve and closed their old calendar year.
Right.
How do they bridge the gap to their new fiscal schedule? Do they just wait and file an 18-month mega return the following June?
Oh, no. The BIR will never wait 18 months for a tax return.
I figured as much.
Yeah, under the rules for short periods, the taxpayer must file a separate, completely independent return just for that specific gap period.
So for that 6 months.
Exactly. So they close their books on December 34, and their new target end date is June 30. They have to file a final or adjustment return strictly for that 6-month fractional period between January 1 and June 30.
And the income for those 6 months is computed just on its own. It doesn't bleed into the next year at all.
Completely on its own. You compute the net income for that specific fractional part of a year. You pay the tax. You seal the gap.
Seal the gap. I like that.
Yeah, and then starting July 1, you resume a normal 12-month fiscal year reporting cycle. The underlying logic here is continuous taxation. There can be no undocumented gaps where income could quietly disappear.
That makes perfect sense. Seal the gap. Start fresh.
Exactly.
Now, let's get into the heavy computational areas. This is where the points really add up on the exam. Sections 48 and 49 dealing with special methods.
Ah, yes. The special methods.
Because for most businesses, chopping time into 12-month photographs works totally fine. But what if the business activity itself literally breaks the concept of a year?
Like a massive construction project.
Exactly. What if you're building a huge infrastructure project that takes 3 years to finish? If you apply normal annual rules, your income gets completely distorted.
Which brings us to Section 48, long-term contracts. And the law strictly defines these as building, installation, or construction contracts covering a period in excess of 1 year.
Okay, let me pause there. Over 1 year. That's the threshold trigger.
Yes. Greater than 1 year.
So if I'm building a bridge and it takes 18 months, I'm under Section 48. What is the mandatory rule here for the board exam?
If you derive gross income from these long-term contracts, you must report that income based on the percentage of completion.
So it's not optional.
It is absolutely not optional. You can't wait until the bridge is finished to recognize all the revenue at the very end. You recognize it as you build it.
But how do I prove to the BIR how much of the bridge is actually done? I can't just guess, right? Oh, it looks about 40% done.
No, and this is a very specific documentation requirement you'll definitely see in multiple choice questions.
What's the requirement?
The tax return must be accompanied by a return certificate from architects or engineers showing the exact percentage of completion during the taxable year. The BIR wants certified, professional proof of how much of that project is physically complete.
Okay, so you need the certificate. Now let's talk about the expense side, because this is where the really sneaky computational traps lie.
Oh, the unused materials trap.
Yes. Let's walk through it. Let's say my construction firm buys 10 million pesos worth of steel beams in year 1 for this bridge project. I paid for them, and they were delivered to the physical site.
Okay.
So on my year 1 tax return, I just deduct the full 10 million pesos from my gross income, correct? Since I incurred the cost.
Absolutely not. And if you do that on the exam, you will confidently select the wrong multiple choice answer.
Okay, why? What's the rule?
You are allowed to deduct all expenditures made during the taxable year on account of the contract. However, the law specifically requires an adjustment for unused materials and supplies.
Unused materials. So let's apply that. If I bought 10 million in steel, but by December 31st, my engineers have only actually installed 6 million pesos worth of that steel into the bridge structure.
Then you have 4 million pesos of steel just sitting on the dirt, unused. And the statute says you must take account of the material and supplies on hand for use in connection with the work, but not yet applied. So you cannot deduct that 4 million pesos in year one.
Oh, wow.
Yeah, you can only deduct the 6 million that was actually applied to the contract.
So it's a strict application of the matching principle.
Exactly.
You are recognizing revenue based on the percentage the bridge is complete. Therefore, you can only deduct the materials that made it that complete.
You got it.
You can't just front load your material purchases to artificially tank your net income in year one.
Exactly. It prevents income distortion. You match the applied materials to the percentage of completion. That adjustment, subtracting the unapplied materials at the end of the year, is a very common, necessary step in a two-point computational problem.
Okay, underline that in your notes, everyone. Now let's shift from long-term construction to long-term payments.
Section 49, installment basis.
Right. This is for when you sell something, but the buyer takes years to pay you. Who is actually allowed to use the installment method to defer recognizing all their income on day one?
The statute breaks it down into three specific categories. First, dealers who regularly sell personal property on the installment plan. Think like your standard appliance stores.
Sure, washing machines on credit.
Exactly. Second, casual sales of personal property, provided the selling price exceeds 1,000 pesos.
Okay.
And third, sales of real property. This third category also includes individuals selling real property considered as a capital asset where they are allowed to pay the capital gains tax in installments.
Okay, so dealers of personal property, casual sales of personal property over P1000, and real estate sales. But here is the most famous rule in this entire topic, the 25% threshold.
Ah, yes, the trap.
Yeah, for casual sales of personal property or sales of real property, the installment method is only allowed if the initial payments do not exceed 25% of the selling price.
That 25% limit is sacred on the CPA board exam. If the initial payments hit even 25.1%, you are disqualified from using the installment method, and you have to recognize the entire gain in the year of sale.
Boom, you're disqualified. But let's clarify how that 25% is calculated, because I know exactly how candidates mess this up under pressure.
Let's logic through an example.
Okay. Let's say I sell a piece of investment land in February for 100,000 pesos. The buyer hands me a 20,000 peso down payment on the exact day we sign the deed.
Okay, 20,000.
I do the math. 20,000 is 20% of the selling price. That is less than 25%. Therefore, my initial payment is below the threshold, and I am safe to use the installment method.
Right. Hold on a second. Did the buyer make any other payments to you during that year?
Well, yeah. The contract says they pay me 10,000 pesos every November. So in November of that same year, they pay me the 10,000. But that's an installment payment, right? Not the initial down payment.
And boom, you just lost the right to use the installment method.
Wait, really? Why?
Because you are confusing the common English definition of initial with the strict tax code definition.
Oh man, what does the tax code say?
The law defines initial payments as all the payments received in cash or property during the entire taxable period in which the sale is made.
Oh, wow.
Yeah, it is not just the day one down payment. In your scenario, you received 20,000 in February, plus another 10,000 in November. Your total cash received in the taxable year of sale is 30,000 pesos.
Which is 30%.
Exactly. That is 30% of the selling price. You exceeded the 25% threshold, and you are immediately disqualified.
That is incredibly tricky. So the BIR looks at the entire 12-month photograph of the year of sale. If the total cash or property you collect in that first year crosses 25%, you're out.
Correct. But notice I specifically said cash or property. There is one critical exclusion to remember here.
What is it?
The law explicitly states that initial payments do not include the purchaser's evidence of indebtedness.
Okay, let's translate that for everyone. Evidence of indebtedness, that is just tax speak for an IOU or a promissory note, right?
Exactly. If the buyer gives you a promissory note saying, I promise to pay you 50,000 pesos over the next 5 years, that note itself is just a piece of paper representing future debt.
Right.
It does not count towards your 25% initial payment limit. Only the actual cash or physical property they hand you in that first year counts.
That is a vital distinction to make on the exam. Now, before we wrap up today's deep dive, there is one last hidden danger in Section 49 regarding dealers and personal property.
The transitional rules.
Yes. What happens if an appliance dealer decides to change their accounting method from the regular accrual basis to the installment basis?
This creates a major risk of double taxation, and the examiner will absolutely test to see if you understand the strict transitional rules here.
Walk us through it.
So if a taxpayer changes from accrual to installment, they have to compute their income for the year of change under the new installment method. But the law has a very harsh provision.
Too harsh.
It explicitly states that amounts actually received during the year of change on account of sales made in any prior year shall not be excluded.
Whoa. Let me think about the mechanics of that for a second. Under their old accrual method, in year one, they sold a refrigerator on credit. Because they were accrual, they recognized the entire revenue in year one and paid tax on it, even though they hadn't collected all the cash yet.
Exactly.
Now, in year two, they get approval to switch to the installment method. The customer comes in and pays the remaining cash for that exact same refrigerator. You're saying the law forces the dealer to report that cash as income again in year two.
Yes, the statute literally mandates that the cash collections from prior accrual sales shall not be excluded from the new installment computation.
But they already paid tax on that sale in year one. That is textbook double taxation.
It is literal double taxation. And while it seems totally unfair, the rationale is that the BIR demands strict adherence to the computation mechanics of the new method.
To prevent loopholes.
Yes, to prevent manipulative transitional loopholes where income just drops off the map. So if a multiple choice question asks you whether those prior year sales receipts can be excluded to prevent double taxation in the year of change, the answer is a hard no. The law mandates their inclusion.
Brutal. Brutal, but absolutely necessary to know for the boards.
Absolutely.
Well, we have covered a massive amount of highly testable ground today. Let's bring it all together for the listeners. As you prep for exam day, here is your ICPA checklist. These are the 4 must-remember principles you should mentally lock in or even jot down on your scratch paper before the timer starts.
Grab a pen.
Number 1, the IC rule. Individuals must use a calendar year. No exceptions, no matter how much business sense a fiscal year makes.
Right. And number 2, the death rule. Death forces a hard cutoff. You must accrue all income and allowable deductions exactly up to the date of death, pulling uncollected amounts into the final return to protect the tax base, regardless of the taxpayer's prior accounting method.
Number 3, long-term construction. Contracts taking over 1 year must use the percentage of completion method. Look for the architect or engineer certificate in the word problem. And crucially, when deducting expenses, always remember to subtract the unused, unapplied materials sitting on the site.
And finally, number 4, the 25% threshold. For casual sales of personal property over P1000 or sales of real property, the total initial payments received in the entire taxable year of sale cannot exceed 25% of the selling price if you want to use the installment method. Promissory notes don't count, but every single peso of cash in that first year does.
If you can master those 4 areas, you are going to navigate these taxation multiple choice questions with absolute confidence.
Absolutely. And as you continue your review, I want to leave you with one final broader thought.
What is it?
Think back to Section 43, where the commissioner can simply override your accounting method if they feel it doesn't, quote, clearly reflect income.
Right.
In a complex, modern business environment, who truly gets to decide what clearly means? The answer is the BIR. That is a massive amount of discretionary power resting in the hands of the government. Keep that authority in mind as you study other tax provisions, because the tension between taxpayer reality and government administration is the recurring theme of the entire tax code.
That is a phenomenal perspective. Taxation isn't just a math test. It's about understanding the authority, the intent, and the mechanisms behind the law.
Exactly.
To everyone listening, we know the review process is a grind. It's tough. But mastering these nuances, understanding the why behind the what, is exactly what separates the CPA from the candidate. Keep studying, keep pushing, trust your preparation, and go ace that board exam. We'll catch you on the next deep dive right here on ICPA Review Radio.